Thanks for the introduction, Mark. Appreciate it. Really refreshing to see that about 2/3 of the people are current shareholders. I'm going to spend about 25 minutes today giving you an overview of the Allianz Technology Trust. I'm going to use a presentation, but really encourage you to ask questions, which we'll handle at the end. And thanks in advance for all of your time. I appreciate it. I'm actually presenting. I'm in San Francisco, in case you were wondering where where I am. And let's see if I can get the share thing right. Uh, should be able to do. Okay, sharing. Perfect. Excellent. So hopefully someone will tell me if you can't see the presentation, but I'm assuming you can see it. So as the introduction said, Mike Seidenberg, lead portfolio manager on the Allianz Technology Trust. I've been the lead since June of 2022. I've actually worked on the product since about 2009, 2010. So it's really been a product that extremely familiar with. Worked very closely with my predecessor, who I think together he and I learned a lot from one another. And miss working with him, but it's been great running the trust and really have a good team that works around me that I spend lots of time with on a daily basis. So with that, let's get going. So let me just make sure I can do this right. It said share screen, and I go page down, and of course it doesn't go down. Okay, but it does on the click, and that's perfect. So we're going to spend a little minute. This is just an overview of what we're going to talk about. I promise you I will keep it fairly high level, and if you have very specific questions afterwards, by all means ask. But I want to make sure that I'm, giving you just a good overview of the trust and kind of what we're about. So, one of the core tenets that we operate on as a team is this notion of technology really being more of a winner's game than a loser's game. And people often ask, well, what do we mean by when we say this? What we mean is that given the rapid changing landscape within technology, you can really identify companies that are going to garner dollars vis-a-vis IT budgets. And the way to think about that is in my career, and I worked at Oracle after business school, cybersecurity was embedded in the software budget, right? So when the chief information officer went to go spend, he or she would spend around cybersecurity would be part of the software budget. Today, as we roll the clock forward, you see cybersecurity is its own line item. And what that means for a company is that there are dollars to be allocated, dollars to be spent around that specific functionality. So when we talk about technology being a winner's game, we're talking about these, almost think of it as like, I sometimes think of it as, when you see those photos of the icebergs that come out of the water, right? These new sectors are birthed and dollars flow to them. Granted, some dollars may come out of other sectors, but what you really want as a company is you want to have a dedicated line item in a budgetary process, because that really tells you that on a consistent basis you're going to be able to get spend there. So that's what we mean by winner's game, and we think that by being able to go out and do a lot of listening, we can identify kind of these technological changes and where dollars are flowing to. And we do that vis-a-vis a very robust, mosaic investment mosaic. We have a proven track record with multiple decades of experience. As I mentioned, I've worked on the trust for north of 15 years now, and I've been investing in technology companies since 2001, having come from tech after attending Columbia Business School. So, I jokingly like to say that, the bulk of the team were kind of a little bit geeky to the extent that we love and are very passionate about technology. We think that having a consistent investment process really kind of lets us really think about stock selection and risk management. And Mark was asking earlier, where I was located, and I told him we're in San Francisco, which I think is a competitive advantage. It's not that other cities are disadvantaged so much. It's just that when you are in the Silicon Valley, when you are in places like San Francisco, your proximity to places like the Silicon Valley, and even today, so many of the companies are domiciled here in San Francisco. It really allows us to, go out and meet with the companies. I'll give you an example, just anecdotally. On Tuesday, I went to go. I'm friends with the CFO of Asana, which is a public company, and he and I hadn't caught up for a while, and he'd emailed me a few weeks ago saying, "Hey, do you want to grab a coffee?" So I went over to their office, which is just a couple blocks from here, and we were just catching up about life, and also he was curious on my thoughts about their stock and potentially ways to articulate the story better. But I do think that there's this kind of, if I think about kind of the ecosystem I live in, it's just really rich with respect to people that either work in technology, invest in technology, and I do think that helps us get our questions answered quicker, and I think it really helps us in our process. Um, so. So the team collectively manages about $6.5 billion. It's really a fundamental research-oriented strategy across all of our products. We really focus on trying to identify secular growth themes within technology, and traditionally we are very structurally underweighted to the mega cap. So if you think about just the relative, if you think about the size of the mega caps in the benchmark for many tech products like ours, we are going to be structurally underweight to those companies. For example, Apple is a 15% benchmark position in the trust benchmark. We would never own 15% of Apple. We have a very active board who I work very close with. We really think in terms of single stock position, never really being above a 10% position size, which, as you think about just how large and how dominant the mega cap companies are. And by the way, I think the mega cap companies are great companies. So I'm not, it's not a disservice to them. It's just that we think that we can identify through our process these mid cap companies that can become large cap companies and hopefully someday become mega cap companies. So this is the team. Spent some time with them this morning. We have a call every day at 6:50 a.m. where we kind of just go over kind of what happened yesterday, who did companies meet with, and we kind of debrief and we talk about what we're thinking about. That's a structured call. We also have a number of other formal calls on a weekly basis. We have a joint technology meeting every Tuesday where we work with our peers in San Francisco. San Francisco is the tech hub for the firm, and we discuss, the various companies that we're working on. And look, interestingly enough, there are a lot of different opinions, but I think that collaborative nature from the other funds really helps us with our fund. The people on the screen, all of us have multiple decades of investing in technology. I think that a number of us have industry experience, and if I think about my the person in the office next to me, who's Danny Su, he has covered the semiconductor companies for more than 25 years. He actually is from Taiwan, spends a decent amount of time over there, looking at the semiconductor supply chain, et cetera, et cetera. So everyone on this slide not only collaborates with one another, but we also have individual stock coverage. And I think as a portfolio manager, I think the good thing about having individual stock coverage, which I still do, even though I'm running the portfolio, is I just think it keeps you really fresh, and it keeps you really kind of, thinking about, kind of as you construct a portfolio, what are the names that need to be in that portfolio. But I think, the nature of the team is to work very collaboratively. So I'll work across the other four individuals on a given name as we're looking at things, understanding that, Danny covers NVIDIA and I cover, Datadog. So that just gives you some sense of accountability. And it's also worth noting that every buy or sell in the portfolio is executed by me as lead portfolio. We have a lot of a lot of people supporting us, in addition to just the team members, as evidenced on the slide below. I think it's probably worth noting just a quick mention about grassroots research, which is kind of think of them as they're actually a lot of ex-reporters and ex people that go out and basically do survey work for us. For example, if we thought a video game was going to be popular, we might work with grassroots research to go out and talk to managers of video game stores, and we really think that this augments our research process, because it kind of gives us kind of very it's very data oriented, and there's no what I call investment bias. So they literally go out, they execute the questions we want answered, and they come back with just the facts. And I think that's a good thing for our team. So our investment philosophy, it's really just kind of, this kind of bottoms up with a macro overview, really thinking about the companies at both from both a technology perspective, but also from an execution perspective, which ultimately, in my opinion, how companies execute around technology is what really drives value for people like yourself, our shareholders. We really focus on if we think about a given subsector within technology, we're really going to focus on what we think is trying to own the best quality management team or the best quality company. And I think that this demonstrates itself specifically in technology, given that if you take a look at the share that the number one or two player has, traditionally it's very dominant. I think the other thing that I've learned just in 20 plus years of investing is good execution is so valuable, and bad execution is so painful. And I remind myself every time I make a mistake and buy a company that I think is subpar, which I try not to do, but happens periodically. You really want to own the market leaders with the best players on the field, even if you have to pay a little more for that. Um, Across the fund, we diversify. We diversify at both, from both a technology subsector level, but we also diversify from a style perspective, and we'll talk about that a little bit later on. So here's the investment mosaic. My kids often ask me what my job is like, and I sometimes liken it to being a detective, in that, I do a lot of listening. I go out, I talk to, or I ask questions to people like, talk to customers, talk to system integrators, talk to competitors, really to really identify, chief information officers, chief security officers, to really understand, where are people spending, or what are things that people are excited about, whether it's a product, whether it's a general technology, where are people potentially saving money by using a technology, and that usually points us in the right direction of where to spend our time. And once we kind of identify these major trends, vis-a-vis our listening and talking process, then we can go out and really think about the sector, right? And think about in terms of, what do the long-term operating margins look like in a given sector, right? I mean, I think that unfortunately for investors, there's a lot of profitless prosperity, given that there are companies that go public in a given sector, and they're just not enough margin dollars to really make them really good businesses over time. And that's not something, I'm interested in. I really care about, what are the barriers to entry? What do the margins look like at scale? And how big can the market be? And I also tell investors pretty regularly, just because a company is public doesn't mean it's a good business. I mean, Wall Street's amazing at selling selling companies to people like myself that really aren't great businesses. And I really try to focus on, businesses that I think have long-term cash flow, long-term cash flow generating characteristics. And so, as we pinpoint the attractive companies, we go down, we meet with them. We really want to understand how they think about the business. And obviously, there's a team of people doing this, and that kind of results in us kind of thinking about businesses we want to own for the trust. That creates that the output of that is a portfolio. It is a portfolio that is both diverse from a style perspective as well as a subsector perspective. And it's something that we have a lot of risk monitoring around. We have daily risk monitoring reports that I receive. Well, we had a meeting this week with one of our risk management people because we have multiple stop loss. Um, we have multiple stop loss rules around the portfolio just so we can know, like, is something a problem that maybe we're not aware that it's a problem. In the final portfolio is about 40 to 70 stocks, depending on the nature of the market. So it's a very high conviction portfolio. It's very benchmark aware, but not benchmark driven. And it's something that really is constructed in order to really have a variety of companies in it. But ultimately, what we want to do is try to make sure that we're monetizing the themes that we think are relevant given the overarching macro. We'll talk about some of the themes later. I won't bore you with too much on this slide, just showing the index. The turnover is actually has gone down substantially since I've been the portfolio manager, since I've took over the trust in June of 2022, which I think is a good thing. And as I alluded to earlier, that 10% single stock concentration, and we typically don't play in the small cap space. It's not a space that we spend a lot of time in really thinking. Our real differentiator is, trying to identify secular companies in that mid cap, large cap space. So, this was kind of alludes to our process. Companies, depending on, where you're located, either, report twice a year and have a conference call, or in the US, most of companies report 4 times a year. That's a really interesting event. There's, obviously we get a lot of numbers, but we think there's more that needs to happen, right? Really understanding, by spending time with management, by actually going to their company, by really talking to the competitors, whether those be private or public competitors, and that really kind of helps us with our mosaic. So the interesting thing about technology today, and I alluded to this a little earlier, is given the size and breadth and the relative importance, you have companies at all different kind of life cycles. And this slide just depicts the technology life cycle that most companies go through. It also allows us as investors to basically participate at various time frames. And this creates what I alluded to earlier, what I was talking to earlier, about the style, about having a different types of styles, right? We can have high growth companies, we can have GARPy companies, growth at a reasonable valuation. Sorry, I'll try not to use too many acronyms. And let me just go back and define high growth companies. These are typically companies that are growing in excess of 20%. They're probably overspending in sales and marketing, and they tend to be less profitable at the margin because they're really investing in their business. GARPy companies, these are growth at a reasonable price. They tend to be a little further along the maturation curve, more profitable, better margin structures. And then you have these what we call attractively valued companies with optionality. And these are companies that typically are X growth. They may have a given product cycle that we want to own. A good example lately is Oracle Corporation. They're participating somewhat in AI. The Oracle is probably never going to grow north of 10%, but they may have a product cycle which kind of bumps up their growth for the next couple of years, which could make that a really could potentially make that an interesting stock. So that's what we mean by attractively valued. But the size of the technology market means that I can create a diverse portfolio. Even if I wanted to own all growthy names, I wouldn't do that, because I think it's important for our investors to have a just kind of this notion of a three-tiered cake from a risk perspective. And that's what this is really depicting. So if you take a look at this slide, is just kind of showing us the value of technology relative to the S&P 500. I lived through the dot-com. I actually left my job at Oracle to go to a startup in the 99 2000 timeframe. That was a very interesting experience. Don't think I need to do that again. But I think that this slide really just demonstrates, there were so many bad ideas at that time period. And granted, I can remember when I first started working on the trust, it was much more recent, but now it's been 22 years since the implosion, or 23 years now. I think we're in a very different place as an industry, which is a good thing. And if you look at the premium that technology trades at relative to the S&P 500, to me that makes sense, because if I think about the way companies are creating competitive advantage, it really is vis-a-vis technology for a lot of industries, right? If you just think about everybody on this call, kind of what your day in the life was like and how digital it probably was or is at this point. If in my case, and not everybody's going to be similar to me, but I wake up in the morning vis-a-vis my iPhone, right? I immediately check the weather vis-a-vis an app. I next thing you know, I'm looking at some work stuff. I like to do mindfulness. I typically do that in the morning. I do that vis-a-vis an app. So I just think we're living in a world that is increasingly digital, and technology companies provide the lingua franca to speak to those customers that are digital. And I don't think it makes a difference whether you're a business or a consumer. I think that digital is something that's really present and relevant in almost all things that we do today. It doesn't mean your lives are totally digital, but I think for a lot of businesses, if they don't look to becoming digital, they really run the risk of being obsolete. So therefore, I think that the premium is warranted for tech companies. This slide just kind of shows us kind of where we were prior to the pandemic. I won't spend too much time, because just it's reasonably it basically, in a nutshell, what it's showing you is that stocks got really extended from a valuation metric during the pandemic. If you look at that November 2020, and these are specifically software companies, and they basically pulled back aggressively, and they're actually trading at a multiple, an EV to sales multiple today that is actually more reminiscent of a time period like if you go back to 2017. And if I knew nothing about software companies whatsoever, if I just took a step back and thought about the multiple and said to myself, is software more or less relevant today versus 2017? The answer to me is, software companies are much more dependent on software today. So the multiples to me seem fairly reasonable, understanding that, the macro currently isn't particularly easy, but I think it's easier than it was a year ago. So this just kind of demonstrates and by the way, just demonstrates kind of where we were, where we've come to. So I kind of alluded to this, earlier, I apologize. Just talking about just kind of the world we live in, these digital networks that are just, such a part of our lives, and really require companies to think about how to interact with one another. And if you think about just for many people that are in the workforce today, they, not only do they work at work, they work at the coffee shop, they might be working on their mobile phone. I mean, they're just all this you're kind of constantly connected. And by the way, that doesn't mean constantly connected is a great thing, but it is the reality of the world we live in. And that's just becoming more and more so as cars become connected, as you have smart homes, et cetera, et cetera. So that creates a lot of demand for spending. And if you think about, just some of the innovation themes that the trust is focused on, this slide just kind of shows you some of the things that the trust really kind of, some of the themes that we're really playing in as an organization. And it's worth noting that some companies may play in multiple themes, but these are some of the things that the trust has really identified as key secular themes. Things like cybersecurity. I don't need to say, everyone on the call has probably heard of AI, machine learning, other things like, as I alluded to earlier, digital consumer e-commerce. So we really force ourselves to try to make sure that we have names that are relevant to the themes we think matter. So this, and I will be cognizant of time. So this is one of the key themes. So if I think about the trust and some of the key themes we're focused on, movement to the cloud is one of them. This slide just kind of demonstrates kind of where we are today and where we're going. I think that the interesting thing for me is that we're still, very, very underpenetrated as companies move their infrastructure from this kind of, from basically a data center, on-premise data center infrastructure to a cloud-based infrastructure. And people often ask me, cloud, so what? Why does it matter? And I basically, this is just so compelling for businesses because they're able to move from a fixed cost environment to a variable cost environment. They don't get stranded with technology, legacy technology, and they just become much more nimble. I'll give you a great example. Wells Fargo, which is, I believe, is in the UK. I saw one in London, but they are a large US bank. And we were talking to the chief information officer, and they realized that they were just uncompetitive. They sell mortgages to people, and they realized that their competitors, because they had a more nimble infrastructure, were able to create mortgage products, right? Whether that's a interest only or whatever teaser rate. You guys get what I'm saying. But they had all these kind of iterations around their product. Meanwhile, Wells Fargo had this legacy infrastructure, and literally by the time that they would respond to the competitor would move on. So, it's not just about, the cost savings of a cloud. It's also about being nimble and being able to really respond and being able to innovate quicker and be able just to, just to be able to get things out the door. And remember, we're living in a world where a lot of those things are kind of software driven. That's why we're excited about the cloud. These are just a couple of quotes that I thought were really interesting from last year when Bill Gates was talking about artificial intelligence and the opportunity it potentially has, and just kind of how it may impact the workforce. So that's something we've invested in. We've really kind of thought about it from both a supplier side as well as an enabler side, and I can answer some questions around that later on. I won't spend too much time on this. Just kind of shows you the progression over time of how did we get to where we are, is with respect to replicating human intelligence. Cybersecurity, which I think is one of the best neighborhoods in all of technology, just given just how vulnerable consumers and businesses are, and what an important spend it is for companies. We're just living in a very, very connected world that means that we're also pretty vulnerable from a cybersecurity perspective, and therefore you have real aggressive spend around that. And I think it's also worth noting that the adversaries today are just so sophisticated. It's not just five people hacking into a high street retailer. It is nation states with well-funded organizations that really view cyber warfare as something that's a competitive advantage for that particular country. So, I mean, this is, I often jokingly say, I won't be talking to you, 10 years from now, 15 years from now, but my predecessor will still be talking about cybersecurity. EV, this just kind of shows you the amount of content that's going into both hybrid and EVs. It's worth noting right now we have very little exposure to this, just given some of our concerns about some of the sales numbers coming out of electronic vehicles. But it's still interesting the amount of content that goes into these hybrid companies. And if you've been in a car lately, I think even if you think about the safety items and just how much of that is being driven by semiconductors, that's a really fascinating place to be. And just the notion of data and just how important it is, in digitalization. I've talked about this a few times, but really kind of trying to make sure that we invest around that. So this is the trust versus the index and the FTSE over time. It's been a good trust to own. There are going to be times where we outperform. There are going to be times where we underperform. But from a long-term perspective, very proud of our performance. This just shows you some of our exposures currently that the trust has. And I will probably pause. These are our top 10 stocks, where I'll probably pause to take Q&A because people are going to ask me lots of questions, probably around these. So I'll pause there. But if there's a key takeaway I want you to think about as we go to Q&A, it's just, if you think about Allianz Technology Trust, think about a trust that is structurally underweighted to the mega caps from a benchmark perspective, and really trying to identify some of these next generation mid cap companies that can kind of grow to be larger companies. So we'll go to Q&A, Mark, if that makes sense.
Thanks very much, Michael. Very interesting presentation there. Just remind people to ask a question, click the Q&A button, which you'll find towards the bottom of your screen. We don't have any audience questions so far. Just encourage people, as Michael indicated himself early in the presentation, the best way to improve your investment performance is by asking questions. There's no such thing as a stupid question. Yeah.
I gave you a leading question. No, it is true.
Yeah,
I mean,
yeah. You need to ask questions to understand.
I have a funny story around that, Mark. I was in a meeting with a company, and I'm old enough that I still like 10Qs and 10Ks, right? There's a lot of information in there, and absolutely. I can tell you most people never look at them. So I was in a meeting with a company. No, it is shocking. I was in a meeting with a company, and I asked the CFO a question from the 10Q. By the way, which he answered effectively, but he said, you're the only investor that's ever asked me about a 10Q question in the last 10 years. And by the way, anytime you want to meet with me, you're welcome to meet with me. So that was
that's nice. Okay. Well, we have some questions coming in now, I'm pleased to say, though I've got a few of my own if we're unsure.
Sure, please. Yeah, by all means.
So first of all, from Vanessa, are you concerned about the increased regulatory risk around Apple? Yeah, there's clearly been some issues with antitrust concerns lately.
Yeah, it's a great question. I would say that I am concerned about the increasing regulatory risk and that drumbeat getting louder around all of the mega caps, all the magnificent sevens to some degree. And here again, these are great businesses. They're very dominant. And I think that regulators are very cognizant and very aware. So I think the answer is, I think it's yes. The answer is yes for Apple, but yes for all of them, which is why we are structurally underweight them. I mean, if you take a look at our position in Apple relative to the benchmark. It used to be 15%. This is as of February. I wonder if it went back up because I saw. At any rate, we're at 1/3 position weight, and by the way, that position, I imagine could potentially go lower, only because I just think it's fully valued, right? And it's not that I think Apple the thing I often remind myself as I think about our Apple positioning is it really is a consumer staple to some degree. If my kids are any example, and in that, people want to go to the store, people want to buy their products. Having said that, like I can't tell you the last product I was really excited about. I'm using, I'll give you I'm using a terribly old, iPhone. At some point I'll get a new one, but I don't hear like, my wife, who tends to like the latest and greatest things, she doesn't want a new iPhone. So, it's really more around my concern about regulatory oversight coupled with full valuation that really kind of keep me on the sidelines from a waiting perspective.
Thanks, Michael. So a question from Joseph. JP Morgan said this week that cracks might appear and that valuations in technology have been stretched. What are your thoughts about that?
Yeah, no, I read the piece. I think tech, generally speaking, obviously there's been a big move in technology, especially early in the year. I mean, one of the things we really focus on is trying to have idiosyncratic stories within the portfolio. It doesn't mean they're immune, obviously. You know, I think valuations are, medium expensive, not super expensive. I also think it's worth noting that if you go back and really look and see what companies underspent the past 2 years, right? Because let's roll the clock back. Unfortunately, we're literally probably within a week of 4 years ago the pandemic. So companies spent, we as businesses and as consumers and as the world, I guess, as we went into the pandemic lockdown, companies had to spend so much money on new technology and legacy technology. We were in the pandemic, people got productive. That's amazing to me. But there was a huge hangover, right? As people went back to work, as we, thank God we're able to, not be in lockdown. And companies had to digest all of what they spent. Now that's 4 years ago, right? And I would make the argument for the last 2 years, companies have really underspent on innovation because they were digesting. Yet the needs from everybody on this call have remained consistent, right? People always want better technology. So and so at business ABC thinks that this application would help drive their business forward. I mean, these types of things, like that desire to do things better really never subsides, even in that digestion phase. So I think that as companies have better visibility around the interest rate environment, they are going to focus more on innovation. And innovation for most, is a good thing for technology because it means spend. So I'm not jumping up and down, but I also think that we're in an environment where a lot of businesses, and by the way, let me be really clear, I don't think all of tech is going back up. I don't think this is a rising tide lifts all boats type of market. I think you're going to have to be very focused and disciplined around where you invest because they're going to be haves and have nots. We've already seen that. We saw that with the Q4 reports, in that, it is a tighter IT spending environment, but it doesn't mean companies aren't spending.
Thanks. Yeah, I think that's fair. Then Satish asks, are you looking at quantum computing companies?
We looked at them a while back, and and I will say quantum computing is something that's been written about a ton, yet there's really no one has been able to make any money off it, for lack of a better word. Um, uh, you know, so I think the day may come when there are some opportunities to invest around it. It just hasn't presented itself. I mean, one of the things that's interesting about technology, and just with hindsight of 20, 25 years now of not only working in it, but in being in the industry and working in, there's just so many things that you read about and hear about, and so few of them become kind of real secular themes, right? I mean, you can go back and you can do your mental Rolodex, and it takes a lot of velocity for something to become, or actually the right answer is it has to have a lot of usability for something to really become a secular theme, right? And I think the interesting interesting thing, and I don't want to digress too much, is one of the reasons why I think AI is a clear secular theme was as we were doing work last year, I went and talked to healthcare companies. I went and talked to energy companies. I went and talked to consumer packaged goods companies, and all of them were putting their best people on artificial intelligence. And that tells me that that's real. That's very real, right? When you see companies moving resources, creating teams, if when you talk to the head of a physician who's the head of an HMO, and he talks for 30 minutes about what artificial intelligence means to patient outcomes, care delivery, and better customer experience, you start to say to yourself, wow, that sounds pretty real.
Mm. Yeah, that makes sense. I guess in the case of quantum computing, it's still in the lab really, and not
It
yet
really
for
is. I mean, it's more of
commercialization.
a, I would say it's more of a, people that are much smarter than I am focusing on it. PhD,
Oh yeah,
PhD is Oxford, and people like that, focusing on it. Maybe it'll become mainstream, and if it does, hopefully our process will allow us to capture that.
yeah, yeah. It's probably a bit early, but one day I think it will be important, but we're not quite there yet. Thanks, Michael. Right, then Paul asks, the UK financial press has been reporting sales of stock by some of the founders of the mega caps. They say the last time this happened, that was an indicator of the top. Any comment on these stock sales?
Well, first of all, it's something we track. It hasn't seemed abnormal. Maybe I don't want to be the Sunday, or I don't know what the gossip, even the Daily Mail, but obviously you had sales of stock by, in the case of Amazon, where the founder got divorced and had to sell some things and give some things, in here again, not my area of expertise on marital divorce, but it hasn't seemed irregular. Put it this way, nothing has caught our eye that appears to be irregular. I'll also tell you that generally speaking, in my career, given the compensation, com- you know, I'm okay with management selling some stock. These people have tremendous net worth tied up in their businesses, and I've never been the person that says, "Mr. Founder CEO, you need to hold on to every share." What I really care about is how they're executing. At the end of the day, like I think some, and it may be a leading indicator for some companies, but I just haven't seen it be a great indicator historically, and by the way, conversely, when they buy stock, like I don't think, most of the people are given options. So the other side of the coin is I don't, when someone buys, whatever, I saw this Snowflake CEO bought, $5 million worth of Snowflake stock the other day. And I said to myself, he has tons of $5 million, is I'm not trying to belittle what $5 million is, but it probably doesn't move the needle for that individual that much one way or the other.
Yes, more of a promotional action rather than anything
Yeah.
serious. Thanks. Yeah, then Mike is asking, why don't you have any exposure to private equity? Is it permitted in your mandate?
It's not, well, the answer is it is permitted, but we've never done it. We'd probably need to go to the board and have a discussion. Um, you know, I view private equity as a very different animal. And I'm not sure that as the team sits today, we would be the best to execute on that. It doesn't mean we couldn't be over time, but I really want to focus on the things we do well. And what we do well are public equities. I've actually been getting some thank yous for not having private equity in the past couple of years from our shareholders. But it just, I think that the misnomer is, Mike Seidenberg from Allianz Trust doesn't just waltz down to the Silicon Valley and get to cherry pick the best deals, right? The reality is if you go to the venture capital people, and you, or the private equity players, and you want to participate as an investor, you probably need to participate across a number of investments, not just
Mm,
the one that you think is interesting. And some of those investments are great, and some of those investments aren't so great. Overall, it's a great asset class, but it's not something. It's just not. It's not what we do. It doesn't mean we couldn't do it. I just think that we'd probably have to think a little harder about the individual that might focus on that for us, should we ever do it.
Thanks, Mike. Yeah, that makes sense. Then we have another question from Vanessa. Are you using any gearing currently?
We're not using gearing. Another good question from Vanessa, I might add. We're not using gearing. We have the ability to do so. We've never done so since we've run the trust. And one of the thinking here, again, kind of going back to what I just was talking about with Mark previously, you know, to use gearing, in my opinion, for you, our shareholders, I need to be really, really right. And I would, it also takes a tremendous amount of time from an operational perspective. And I think our efforts are better served focusing on the technology sector, which we do, which by the way, has plenty of volatility. Right. I don't necessarily need gearing to create volatility in tech. I have it. I have it. So that's kind of our thinking has always been it's inherently volatile enough without adding gearing to the mix.
That makes a lot of sense. Thanks. Then another one from Satish. What are the principal risks that you're concerned about, both tech specific and at the macro level?
Yeah, I mean, so at the macro level, I'm still, have two eyes open on inflation, right? Because you want to make sure that it comes down and that the consumer doesn't kind of peter out, right? Because so much, I've often jokingly said, how goes the consumer goes tech, because I think that, at the end of the day, we all go to work and, how you kind of feel about your job is somewhat a question of how you feel about your situation, right? Financially. So I think a lot about the consumer, and that keeps me up at night a decent amount. Although the consumer, generally speaking, cycle over cycle is so much more resilient than I think the consumer typically would be. And by the way, that's a positive thing. I worry about, obviously in the US, we have an election coming up. That's something I think about because I think it'll have global impact. From a technology perspective, what I really worry about is just making sure that we don't have all of the spend against artificial intelligence and then a pause as people kind of innovate and use it, and then you'll see another spend. So I kind of worry a little bit about an air pocket there.
Mm-hmm.
As I had a slide earlier in the presentation, we've really taken down our exposure to autos, and we were early to do that. I didn't like what I heard when I met this past summer with some of the auto semiconductor companies. Things sounded tricky. So not only do the semiconductor sector is dependent on a lot of things, but a healthy auto market is a good thing for the semiconductor sector. It's not particularly healthy right now, so we don't have any exposure to that. At some point, we probably will, but I worry, I do worry about that. And just I worry about just overall, just a little bit of a, buyer fatigue on the, just that you probably have, organizations that are running leaner that that are trying to do too much, and therefore do they just say, what, we're going to hold off and we're going to put this on hold and we're going to focus on these three other things. The good thing is technology actually helps with a lot of that. It makes people, tends to make organizations more efficient. Look, I go back to this idea that longer term, I'm not worried about technology. And it's because if you think about sectors where countries like the United States and the UK really dominate, we've just been so dominant in this sector. And it's not been dominant for the sake of technology, right? It's just as companies embrace and use, they're either, I've jokingly say companies buy technology for three reasons, right? Selling more stuff, taking costs out, or having better customer service. Those are the three reasons, right? And technology solves those three problems a lot of times. So that's why I'm overall, very constructive long term about technology.
Thanks, Mike. Then from Lionel, will the board consider a share buyback program to narrow the discount to NAV?
Yeah, the 100, great question. They are not only do we've been in a share buyback process. They are incredibly cognizant of the discount. We understand. That's not good for our shareholders, and the board. We've been in a share buyback. It's not something that that we there are people that will take advantage of it if you tell them when you're going to do it. But we've been very active. Michael, who's on the call, may know the exact number of shares we've bought back this year, but it's a pretty large amount.
Thanks. As there are no open questions from the audience, that gives me an opportunity to slip in a few of my own.
Sure.
So first of all, I wondered you've got a portfolio of about 40 stocks altogether. Which two or three out of those 40 do you find most excite you, that you think have the biggest upside potentials? Not necessarily the same as your largest holdings, but which
Interesting.
are most exciting to you?
Yeah, I mean, by the way, it's a great question.
Thanks.
Uh, I think some of the cybersecurity names still, on a multi-year basis, still have so much opportunity,
Mhm.
primarily because it's such a durable theme in technology and it's such a pain, it's so painful. Um, you know, if I had to choose, so that's the neighborhood I probably like the most.
Mhm.
Um, I look at some of the semiconductor companies around, some of the kind of nichier ones around power management. Monolithic Power is a company that,
Mhm.
if you just think about, they're so differentiated the way that they go about interacting with their customers, and that they participate in the design, they participate in the cost down. Um, you know, if you ask me, 5 years from now, because I think it's hard, I think a company
Of
like
course,
that
it's hard.
continue.
Yeah.
I think a company like that continues to do incredibly well. I'm very attracted to something like a TSMC that trades at a
Mm.
real discount, right? And if you think
Mm.
about just how important leading edge semiconductors, and I know why it trades at a discount
Obvious.
because they have a big neighbor
Taiwan.
that doesn't that would like to come over for dinner and stay for the rest of eternity.
Yeah.
Um, but I think that's an interesting business, and that the barriers to entry for leading edge semiconductor manufacturing are just enormous, right? I'm not convinced, all United States, Europe, a lot of places are trying to replicate that with the help of TSMC. It'll be curious to see if that's replicatable. Excuse me.
Mm.
Those are just a few things that come to mind. Trying to think if there's anything um, that we've toyed with,
There's
you know.
some interesting food for thought there. Makes a lot of sense. Thanks, Mike. So we've got a question from Vasant here. Is there any growth left in the Magnificent Seven?
I mean, they're still going to grow. I mean, like, look, I mean, there's still like such budget takers, but yeah, yes, they're going to continue to grow. Because they're all expected to grow revenues this year. The question is, like, will they moderate? Will they will the will the rate of growth decelerate? So that's the
Mhm.
bigger issue, probably.
Thanks.
And by the
Yeah,
way, Nvidia is going to grow like I know they're in that group, but Nvidia will grow like a weed. I mean, it's
well,
such a
that's
dominant.
funnily enough, that was going to be my second question.
Yeah,
Um, Nvidia has been a phenomenal company, particularly over the last 2 or 3 years.
yeah,
It's grown at an incredible rate.
and
But
profitable.
that cut, yeah, I mean the profits. I think it's multiplied 5 times,
Yeah,
if I'm right, over the last year, and still a way to go on that. But it can't keep growing at that rate forever. So I wonder what would be your criterion for taking some profits in Nvidia or
yeah, and we have taken some profits, so it's the
okay.
weight that you're seeing
Mhm.
today is not the
Mhm.
weight that it is. Um,
Mhm.
yeah, and one of my concerns was just the first derivative, right? Like the rate of
Yeah.
change. Um, Amazing company, dominant supplier. If you talk to users of the CUDA software development kit that they deploy,
Mhm.
people absolutely love it. A little concerned about, could there be an air pocket
Mm.
And then they'll reestablish growth, maybe, and that's probably why, from a multiple perspective, it's not particularly expensive if you
Oh,
take a look at earnings growth at all. Um, Especially given kind of how good their margins are. Some concern on the margins, like, well, they need to invest in some other businesses. But the interesting thing about NVIDIA is they continue to take on ancillary aspects of their business. They just announced some networking product at their developer conference. What was it, 2 weeks ago or last week? So I've taken it down a little only because it was just such a big absolute position. Um,
mhm.
uh, you know, it probably I may prove to be wrong. I just think there could be a digestion phase. But I don't think the Nvidia story is over, to answer
No.
your
Yeah.
question. So at some point I hope to make it larger.
I see. Right. Yes. So it's just a little bit of safety at the moment.
Yep. And I'm
Yeah,
okay with taking profits.
absolutely. You don't, as you say, you don't want to be super concentrated in one
Yeah.
name. That's definitely a risk. Um, Good. So, funnily enough, you touched on my next and what, unless anyone else has any other questions, what will probably be the final question when you spoke about TSMC. Um, Looking more broadly, have you done a scenario analysis in the unlikely event, well, hopefully unlikely event that China did act on Taiwan? I guess that would have impacts across the whole
Well, I think
tech
yeah.
sector.
Yeah, I mean, first of all, I think it'd have impact across lots of things outside of tech as well.
Sure, sure.
Um, and let me be really clear, I don't think it'd be a good thing for the stock market. I don't
Not.
care where you are in the stock market, not just tech. It would be a bad thing,
Mm.
across the board. Yeah, it's something we think about. I mean, and, uh, I continue to, and here again, I'm not, luckily, I don't get paid for my, political, not
No,
political
no, but
strategy
I
knowledge,
mean,
but it's something,
it's a what if
it's a
question.
fair,
If it were to happen, what would the
total,
consequences?
if it were to happen, I think you'd really have to look hard at a lot of the semiconductor capital equipment companies, because so much of their product is in that locale, right?
Mhm, mhm.
And then you have an invasion. And my guess is, if you're China, I would know where I would bomb. But it would be very disruptive to the global supply chain for technology,
Mm, mm.
and
Yeah,
not good.
it would have a big impact.
Big
Well, that's
impact.
been great, Mike. Thanks very
Yeah,
much
thanks for your
for all your
time.
time
Appreciate it.
there. Great. Okay, well, we look forward to seeing you again, hopefully in the not too distant future. And good luck
Okay.
with
Thanks
everything.
everyone for your time
Thank
today.
you.
Have a great day.